So very good morning. Welcome to the rundown for Wednesday the 6th of July. First off then, let's just take a bit of a recap on some of the price movement which we saw yesterday, starting off with the pound still remains the predominant focus of the markets. We were talking about this time yesterday that key 131.33 kind of line in the sand as the post-Brexit low would have been one of the key areas to look out for, and that indeed did end up being the case. We had an initial test early in the session when we came in yesterday. It took initial bounce, but then when it did move, it can quickly move back down to the 130 type level to before. Overnight in Asia, this move that we saw, if you do put your charts on a minute candlesticks, there was no new news. But when in overnight Asia Pac trade, if you're looking at sterling futures, liquidity is pretty thin. And then when we start breaking large psychological and technical levels to the downside, bearing in mind we are now trading at fresh 31-year lows here in cable, then the price movement tends to go from handle to handle in pretty quick succession. Also as well, when you see quite a large wick as per that last candle there, then that's another signal to me that that's kind of more of a technical play in thin markets overnight. It's gone down to the low print was just shy of the 128 handle before we bounced back up. The kind of natural retracement, I guess, is back to that 130 mark. That is kind of this kind of psychological round figure, and that's kind of where we reside then this morning. If I put this down to 15, we've kind of recovered slightly since that initial Asia Pac move. Again, none of this is around any specific news. You've heard from the Conservative leadership race. They've started that process of narrowing down the likes of Liam Fox, Stephen Crabb not making the cut, and they've backed Theresa May. But none of this is having a direct influence on the pound. Those two guys were never in with a look in anyway. This is simply more technically driven, and also a lack of liquidity in the overnight session caused that pop lower, and then so a natural kind of retracement. Some of the things and reasons why it came under pressure yesterday, as we've said then, it's largely technically led, but there was some news to be aware of. We had Mark Carney speak. Pretty boring speech overall, certainly nothing as punchy as what we got last week when he was extremely dovish. He did say, though, he warned that there is a prospect of a material slowing of the economy and that the financial risks of Brexit have begun to crystallise. Now, those words were quite on point yesterday, because in the last 24 hours or so, there's been 3 UK commercial property funds worth around £9.1 billion that have suspended redemptions. So we're starting to see kind of the real effect now that the Brexit is starting to have on large-scale investment decisions within the UK. The vulnerable position that commercial real estate in particular now sits in following the vote and that outcome. Most analysts, they'll be expecting similar type funds to be doing the same in the coming days and weeks. But as per always with the impact of news, it's kind of the first couple of funds to mention that they're kind of withdrawing their investments causes the biggest movement in the market. And then as they start to come in from now forward, the market's kind of built in that's the new norm, so to speak, so the impact lessens. So I think you've got a bulk of that reaction was technically driven, I think predominantly taking out those key levels, particularly the post-Brexit confirmation of that, and then the 130 handle. But then also you're seeing some real actual direct investments into the country in the commercial property sector getting withdrawn, and that's definitely a net negative as we start to see the real feed through of the Brexit. Another key factor as well which weighed on the markets, I do think that it was almost self-fulfilling in a way. A lot of people, like we were looking at those levels in the pound, and when that started to go, it was kind of the lead barometer for a lot of other assets, and certainly led to some risk-off trade. You also coupled that with oil prices. Just sharing my chart with you here. Let me just mark this up to get an idea of kind of where we were from this recent move. We're talking around a 6% drop here in crude oil in a very short period of time. We've moved from around the $49 handle down to 46 in late yesterday or overnight session. Now you've had the Nigerian pipelines, some of those coming back online after militant attacks that we saw at the weekend. That was one thing. You've also had Cushing showing a build. I think it was roughly about 235,000 type build. This comes ahead of the APIs we get tonight and the DOEs tomorrow. These are a day later than normal because of that Independence Day holiday on Monday. So a couple of factors there dragging on crude oil. And then from certainly a macro perspective, as it starts to hit home, not just the domestic impact that Brexit will have on the UK, but the overall slowdown that will have on European growth and net global growth, that's going to reduce demand for crude as well. And so there's some certainly negative forces to weigh on crude in this recent move to the downside. How far we'll go from here, I think, we'll have to wait for the next key inventory numbers to really judge on a weekly basis. But that's been another dragging factor for equities, and certainly in terms of the lead, if we go back to the DAX yesterday morning, it really got hit at the open. That was when we had that kind of contagion, if you like, about the Italian banking sector. Those, especially Monte Paschi, they were halted, limit down in Milan again. Some of the other Italian banks bounced, but overall the sector still under pressure, and there are mounting concerns in the periphery with a lot of focus on Italy for those political uncertainties that we've got with the reform referendum coming up later this year in October, I believe. The chart I just saw in HSBC's note this morning, which I think kind of wraps up what I'm talking about, and this is Eurozone banking sector performance as a possible sign of contagion. Anyone who's lived through the financial crisis will know that the banks are the most highly sensitive sector to market movement, if you like, and certainly from a sentiment reading or barometer, the banks are quite a good sector to look at. They tend to see the first and most violent moves, so often seen as a lead indicator. And if you look on this chart, you can see the Euro Stoxx banks against the overall Stoxx Europe 600 index. And you can see here, they're pointing out the UK referendum, the sharp dip we've seen on both indices, but you can see the Stoxx 600 as a whole has held up much better than the actual Stoxx Banks index. And so does that spell kind of more trouble to come for the indice as a whole going forward? These are certainly things to keep an eye on. The banks are a good way of picking up sentiment within the market. The other thing, of course, that we keep seeing here, I think Bill was talking about it yesterday, the pretty much entire duration of the curve in Switzerland negative, but you can see here almost now $10 trillion of sovereign bonds have a negative yield. We were already on a downward trajectory. That's just taken further momentum to the downside. The red line there indicating when the vote took place, and you can see here these are yields on the white line's global developed sovereign bond index. You've got the Japanese, they're the kind of, Kuroda, I can only imagine what he feels like at the moment in trying to find a viable solution to counter this. And then you've got the German 10-year, which at the moment is getting ever closer to kind of dangerous territory, or at least with the German 10-year bund yield hitting around minus 0.2%. Don't forget, the lower these yields get, the smaller the universe of eligible bonds that the ECB can buy. If you remember those source comments we had last week, which created sharp volatility in the bund future, that's because ultimately, if things continue and this downward path of negative yields continues in the euro area for one, then that means then that the ECB ultimately are going to have to open up their program, or at least change the criteria to open to other assets, move away from the capital key formation, if you like, and so that peripheral type nations can be picked up, and that's going to be to the detriment of the Bund if that does materialise in that scenario, again as we saw with some of the moves last week on those source comments. Quick look at what we've seen so far this morning. We've had German factory orders. They did come in weaker than expected. You can see here no show on the bar chart. That's because it was flat month to month for German factory orders. Market has not really paid too much attention to that. It's a pretty volatile data set, as you can see, but looking at the charts this morning, I've got the DAX here top right, got the pound on the left, crude oil on the bottom left. I think you've had this cash market open move to the upside. We closed the gap, and now you're seeing another push to the downside in the DAX, moving back in towards the intraday lows, which were close proximity of the S1. I think the overall trend certainly is still one of negativity, but when there's no outright one single headline, the market has to go in this almost staggered effect downward. We get a bit of relief here. That coincided with the cash market open, but ultimately the prevailing theme is still a negative one. So as such, if this DAX does start to push down to S1, already starting to see a bit of a lift in Bund futures. We'll be eyeing that 168 handle upside in the Bund. Let me just bring that up. $168, that was around yesterday's high print, that round figure. Again, we're only trading around 7 ticks off that at the moment. Let me just bring my gold chart into shot as well. Important here because we have broken, you can see here technically that held up as good resistance initially back on the 4th of June when we saw that first test up around the 1361-62 levels, but we've seen a clean break of that during the overnight session, and so we surged up to post-Brexit highs now in gold, and as we've been saying, with the premise being the Fed delaying their rate hikes, Mark Carney at the Bank of England signalling more easing to come this summer, the ECB more than likely to expand their program of QE. This should all be supporting factors for spot gold. Couple this with things like deterioration in the Italian banking sector, fears of what that could mean for European contagion, profits likely to fall in Q2 US earnings season, which kicks off soon. Forecasts and outlooks for the forthcoming Q3 quarter and full year likely to be downgraded. And then you've got the Brexit risk looming. There's a lot out there to support more upside here in gold, not just today, but as an overall trend in the coming weeks and months. Rounding things off then, quick look at the calendar for today. It's quite a busy one. Just make this a bit bigger. Nothing really too much else now for the morning, but certainly this afternoon you'll get some key readings. You've got US trade balance at 1:30. The thing that's really going to catch my eye though is the ISM non-manufacturing composite reading. Let me just bring it into shot. The reason why I think that's important, because this is the data set as we've seen in the last few months, and ISM non-manufacturing last month decreased 2.8 percentage points. That was below expectations and the lowest reading since February of 2014. Business activity, new orders growth slowed and employment fell after rising in the previous 2 months. So again, we had a particularly low reading here last month. I'm watching this closely, and then also non-farm payrolls will be very interesting, given that payrolls in particular has seen 2 very disappointing readings. You have had Fed speakers come out overnight. Fed's Williams, who's more of a centrist, said that Brexit, as it has played out so far, is being a relatively modest risk to the US outlook. And he also reiterated that the Fed hike this year could be still warranted should the data come in consistent with their outlook. So he's paying close attention to the data should it come in to keep their outlook. Remember, their outlook at this point is still two rate hikes this year. That payrolls figure, if it comes in a low ball again for the 3rd consecutive month, I think it's a very hard argument to keep such a hawkish rhetoric up from some of these Fed members. Dudley, who's a leaning dove, also spoke. The New York Fed president was a lot more cautious, said that while it is still early days to fully grasp the consequences of Brexit, If there is a broad contagion through financial markets, and if it leads to a greater consequences about stability of the EU, then it could have significant consequences. So there's already quite a divergence among some of these Fed members in what they're telling us. If these data points, such as today and non-farms on Friday, then at what point do you start not talking about delaying rate hikes? Do you then start talking about potentially what can the Fed do to help prop up the market? Then we start to move into a new policy era or way of thinking, certainly. Okay, back to quickly to the calendar. There's a lot of speakers today. Keep an eye on your calendars. The guys in-house, I've printed you all out a copy of this, put it on your desk. I don't do it for my own pleasure. I do it so that it's in front of your face and you don't forget to be checking these things. You've got to be careful on a day like today where you've literally got around 5 or 6 ECB speakers, because at this point one of them could say something hypothetically about what they're intending to do. They might give a tip off on what they're thinking with the QE program and any changes they could do in the future. So it's always good to know when the risk event times are, and we're kind of clustered around the morning, but also this afternoon. You've got ECB's Mersch and Fed's Turillo, who's a voter as well and is speaking on monetary policy from a Fed perspective. So again, make sure you're on point with these calendar events. Okay guys, that's the morning briefing. Thanks for listening. Have yourself a great session. Thank you.